Hey traders, Steven Kowitzel here with thetradersplan.com. It's good to be back. We haven't done a webinar for a couple weeks, with Thanksgiving, and then I had a trip the week before that. So, it's probably been a good stretch to not really trade a lot since the last couple of weeks. You really have had a lot of this. But the market surged yesterday, and we're going to talk about that. We're going to talk about what can happen if we're going to get a rally out of this. So I really want to start with the S&P 500 just because I think there's more to talk about here on the chart as far as explanations, and I want to tell you why. So a lot of times you do have these waterfalls that happen, right? They start the correction, they just get slaughtered, they go down, right? That's what I call the waterfall. And then bad things happen. So once you get that crack, you need to pay attention. So you get the waterfall, and what's really important in these corrections and in these rallies coming out of corrections can be incredibly strong. Okay, they can be really, really strong. So you don't want to fall asleep at the wheel. Now, a lot of times when you have that decline of the 20-day EMA, which is the red line, we're going to pay attention to the 20-day EMA a lot today because that gives us clues if we can get a rally to get out of this, or maybe have a December rally. So a lot of times what happens is, this is kind of reminding me of the 2015 correction, and we're going to look at that here in a second to compare. But you had a sell-off, a bounce back, and it got close to that 20-day EMA that was declining, got rejected. Another sell-off, and then you had a punch through, but then it immediately got rejected. So normally what I found in corrections is you don't always get a punch through on the second time, but sometimes you do. Sometimes it'll just hit it and then take another leg down. But you had a failed attempt at a rally, right? A second fail, and then it got slammed down again. Now, just like when I always like to use the rule of three, right? Once a stock has hit a support level twice, typically it gets tired, and then on the third one, the odds of it cracking support increase significantly. And this is just through chart reading, through studying. Same thing on the downside. Once you have a downtrend and the attempted rally gets rejected twice, I'm kind of chomping on the bit at that third time, because it's just like, if you want to compare it to Vegas, right? Every time you win, whether it's you're playing craps or just whatever the case is, every time you lose, you're getting that much closer to a winner. Every time you have that failed attempt. So typically on leg downs and corrections, you typically do have second failed attempts. A lot of times the third one is the charm. So you have two fails, and then you have a big double bottom right here. You have a test of the low, and it's not an exact, test down to this exact point or undercut it, but it's fairly close, right? You got a lot of price action right here. You had a candle with the reverse, but we have a clear double bottom right here. Then you get that breakout day, right? That surge yesterday. So now what we're going to pay attention to is, can the Nasdaq and the S&P 500 hold this 20-day EMA? Or is there going to be more slop? Now, if it breaks, I think that increases the odds of it just chopping around more. It doesn't mean it can't break and come right back. But a lot of times, when you've already had those two failed attempts, and then you get that third surge above that 20-day EMA, more times than not, what I have found is that 20-day EMA should hold. Doesn't mean it always is going to, and then you can get a rally coming out of this. Now, how far, wide, or long that rally can be, no one knows. Everything is different. But I'm recording this midday on Thursday, and so far the price action is good, where it hasn't given. Now, there's still 2.5 hours left in the trading day, but it hasn't given a lot of this price action back. I think it's going to be incredibly bullish whether the market's up or down, as long as you know, this price action closes in the upper half of the range. That means there's more accumulation, even if it's a down day. So they're not wanting to give back this big, you know, Fed announcement, this Powell surge, right? This could just be enough for a rally. Obviously, we have a lot more going on with Trump and the Chinese president being down in Argentina this week. But again, I think you need to put more focus on the price action. Whether Powell did this or not, it really shouldn't matter. Whether what happens with President in, you know, China and Argentina really shouldn't matter. I think you need to focus right now on the price action in that 20-day moving average. Is it going to hold? Can we rally out of this? Now, some rallies you have shakeouts, like right here. You had an attempted rally. It went up. It crossed this double bottom right here, and then it failed, but it did find support at the 50-day moving average. So just keep in mind, and I'm sure, I hope right now you've seen my moving averages webinar, but you know, the more room you give it, you know, a lot of times the less whipsaws you're going to have. But the 20-day moving average is the strongest rally line, in my opinion, because you can see then it rallies again, and it finds support several times. Break, shakeout, comes right back, finds support, and then it breaks, and then it breaks. So let's look at this, right? We got a double bottom right here. Let's keep in mind where we're at. Now let's go look at the 2015 sell-off to see how similar it looks. So it sure does look a lot similar, right? You got the waterfall, you got the bounce, that first bounce, got rejected at that 20-day moving average, came back, took another stab, plunged through the 20-day EMA, immediately got rejected and failed, came back, double bottom, breakout, rally. So it's so funny, you know, if you look at it, and I'm not saying every bar is the same, but if you look at it, you know, first attempt, you know, punched through and then failed, and now you got another double bottom and a potential breakout. Right here is right here in 2015. And it's, I almost feel like you could lay these on top of each other and they would look very, very similar. So I'm showing you this to really say, you know, I think history, as far as corrections goes, it does repeat itself. Doesn't mean the 20-day EMA is the end-all, be-all. But as far as a strong rally, it's always been the strongest indicator that I can find that I think is reliable and simple, and anyone can use it. So are we going to get a rally like this? You know, I have no idea, but it seems likely that if we go sideways, going back to current, if we go sideways even a couple days, give that 20-day EMA time to curl up, I think it's likely that we do get a December rally, as long as the fundamentals, and by fundamentals I mean Trump's meeting with China, doesn't go horribly wrong. Because I think the market's now move off of Powell and on to you know, the Chinese president. So, but keep in mind that all corrections, and we'll look at a long-term corrections, you know, they take a second leg down, so they're sucking. So here's what's happening. You know, probably whipsawed some of us out, right? And that just happens. It's going to happen. Whipsaw is a part of trading. If you don't like it, don't trade, says Ed Dakota. And then you have a rally, and then it shakes you out. So you know, you can hold it as long as really it's above the 20-day EMA. But you remember my rule of three. You really had one test, two tests, and then the third test failed. So a lot of times on a strong uptrend, you'll get support twice. The third time, it increases the odd of a break, and it does. Now it sucks you back in and goes sideways, all nice and tight. Right here, you think everything is good, and then just starts to crack. Okay? So then it cracks, and we have a second leg down. But it's interesting how this double bottom, you know, couldn't break an all-time high, traded sideways, chopped around. A lot of people were chopped around and spit up right here. And then it almost has the exact same double bottom over here. Breakout, and then it takes off. So do I kind of think something like this is going to happen? I think we're right here. If you know, the 2018 chart was laid on top of the 2015 and the 2016 correction, I think we're right here. if we get a rally. I wouldn't be surprised because typically corrections do take that second leg down. So all I'm saying is, you know, use moving averages. I think they're a simple exit strategy, or take some profits into strength, whether you sell 5% or 10%, sell half of your stocks that you're buying on this rally, sell them as they're hitting price targets, and then let the rest ride. And then as they start to break support, then you can get out of them. But so then you have rallies coming out of corrections, and every time we're in a correction, I come back to these other corrections because just want to show you all the possibilities, right? Just because I think we forget. So then you had a failed breakthrough, and then it just took second leg down, undercut this low by 2 points, and then rallied. But what's even interesting is on this rally, you can see it tried to close below the 20-day EMA, and then by the end of the day, closed back above it. So when you think you're in rally mode, I think it's important to try to wait to the very end of the day because the market can find support, come back. I've seen this several times in corrections in the past where it starts to come above the 20-day EMA. You get that slam down in the morning, that shakeout, but by the end of the day, it just completely comes back. If this happens, that is an incredibly bullish indication. And if you get this crack below the 20-day EMA, get this long candle and closes back above it right after a breakout, it might be helpful to back up the truck and buy as much stock as you're comfortable and try to play the rally. Using stops under this low is fine. But so again, we're still early. We don't know what's really going to happen, but right now I think a rally seems reasonable after a double bottom test, after multiple fails. So now I say that to say this, there's a lot of things that are still bearish right now, right? So I think in the short term, you can make a case for a rally. I think I can make a case for a bullish rally, but in the big picture, I think the big picture is still bearish for a couple reasons. Why? You got this 50-day moving average, the green line, that is close to crossing below the 200-day. It's not there. If we get a rally, it'll curl back up, but it has crossed below. So you get that death cross. That's never good. It doesn't mean you can't make money, but historically, you're going to have a tough time when you get that death cross. And if you would have used a golden cross, death cross rule back in the 2000 peak, back in the late 2007 peak, boy, it sure would have saved your bacon on some major bear markets and some major downtrends. So just kind of keep that in mind, right? We're trying to be objective. We're trying to use little rules and little filters to help us out. So if we look at the weekly chart of the S&P 500, it was interesting. You have this almost 10-year trend line. Man, geez, where has time gone? But anyways, so you have the 2010 correction, right? It hit. So I have resistance, and then I have support, right? A very long term. This is a weekly chart. You have in the 2010 correction, you have the leg down. It really chops around multiple times. Say it took its second leg right here and then went on a big rally. Look at that rally coming out. But this correction was 10.3% deep. Again, you have the 2011 correction. This was when the S&P 500 got downgraded by, I can't remember if it was S&P or the Moody's, but I remember this. I think this was when Dubai was going to go under and take under the world and all that good stuff. So you had almost bear market. But again, you see that death cross. Now this is a weekly death cross. Look just how hard it is, and then finally you come out from under it. So one could easily make a rule, don't trade while you're in a death cross. It will probably save you some money over time, but then you get a strong rally coming out, right? And then we go back to the 2015, 2016 double dip, which we just looked at. So you get, weeks, a couple months worth of chop on the bottom, rallies, another couple weeks worth of bottom, and then you get your breakout. Same thing here. Comes down, chops, tries to rally, failed rally, and then comes back, you get your second win. And then we've had a lot of 10% corrections this year, and I'm going to talk about that here in a second. So you can see right here, this blue line, at least on the weekly chart, it is almost about to cross as far as the death cross on the weekly chart. But you have your corrections that has tested this long, it's gotten very close to this long-term trend line that dates all the way back to July of 2009. And I think it's a healthy test when it comes back to this line because, they're forever, even when we first were getting the sell-off, the correction earlier this year, it wasn't even coming close to this trend line. So now we're getting that trend line touch, or at least close to it. Let's see if we can rally out. But again, corrections typically, they're going to last a few months, and that's just how it goes. Like all these, you can see if I inspect this, kind of see how many periods this lasted. This lasted 20 weeks right here. If I start the correction from here and go over to about right here, 23 weeks. Let's look at this correction from here to, we'll call it about right here, approximately 40 weeks worth of chop. Then you had this correction, and I'll say right here you have, where is that? Oh, I can't see where it went, where the periods, okay, so I see it now. So then you had about 15 weeks worth of correction. And so you have a minimum of 15 weeks. Now we are in 9 weeks, okay? So you have a couple of 20-week plus week corrections. You have a 40-week correction. You have a, 15-week correction, and we're in week 9. So I'm just showing you this to keep in mind, what historically has happened. I seriously doubt we come out of this correction right now and then just head off to the races. Like, we'll get a nice rally, and then I'll probably chop around for a bit. It's important to look at history so we know what to expect. Now, I talk about death crosses. The Nasdaq is in a death cross. The 50-day moved under the 200-day right here. But the interesting thing is, you had that breakthrough of the 20-day EMA yesterday. The Nasdaq surged. It was up almost 3%. Tech stocks were leading. That's bullish. That's what you want to see. And now you kind of really have, if I turn off this inspect button because I don't want it to get in the way, earlier today you had a 20-day EMA touch and then it's moving back up. I think that's a good sign. Even if it trades sideways, I'm really hoping that it does stay above this level. We're just going to wait and see. But you're in a death cross. So keep in mind, the Nasdaq came under more pressure than the S&P 500. You are in that death cross. You're in a bear market type of environment. Now, if we get a rally, it could curl back up. We could be out of this. But if, the 2015, 2016 scenario plays out, we could get a nice playable rally. So I'm not telling you not to play it. I'm just telling you, just watch the 20-day EMA. If we go to, now let's look at this for a second. This is a long-term chart going back to 2000, of the Nasdaq, going back to 2008. This is a zigzag line, and you can just do this by going zigzag 10. And what that means is every leg down, or every leg, whether it's up or down, is a minimum of a 10% move. So look at all the 10% down moves. You had 2 10% down moves in 2010. You had 1, 2, 3 in 2011. A couple in 2012. You didn't have any in 2013. You had 1 in 2014. A couple in 2015 and 16, or 1 in each year. You didn't have any in 2017. And then so far in 2018, we've had 3. So we've had 1, 2, 3 10% moves to the downside. So volatility is nothing new. It's here to stay. I think it is important at times to have a trading plan in place that gives your stocks or gives your investments enough breathing room where you're not just getting stopped out too quickly. But again, you want to stay out of the bearish environments, kind of the death cross, and try to focus on when the long-term trend is up. And I think it's just simple to say that, the shorter you go, if the 50-day moving average is curling up, you know, you're in an uptrend. If the 50-day moving average is curling down, you're in a downtrend. It's just that simple. You can just play that. And if you're ever curious what trend is up, I think that is kind of a nice intermediate range for most people to trade off of. So look at all of these corrections, all these pulls back, and since this is a 10-year chart, the Nasdaq is still up 374%. So just keep that in mind. Now, if I go to a year-to-date chart, let me go back here. What am I doing? Of course. Okay. Don't worry about all these labels. But again, this is the Nasdaq, right? You had 10% leg down, then a 10% leg up, or more than a 10% leg up, and then a 10% leg down, and then a nice move, and then a leg down. So it's interesting that in 2018, it has been a choppy year. In my opinion, you had this good trend coming out, right? But you've really only had one good trend, one good rally. This was pretty, even though it was a 10% rally, it was pretty sloppy. The S&P did not break out to an all-time high. But the Nasdaq is still up. It's up 5%, 5.3%, and all this volatility, right? So it's just important, you know, I show you this, you can have volatility and you can still be up. You know, even though 5% isn't a great year, you know, it's better than owning a T-bill, or it's better than sitting in a 1% money market account. So, you know, I understand it's risk reward, but, you know, I'm just showing this, show you how you can have volatility and still be making a little bit of money. Okay, so I can't remember. I know we just looked at the Nasdaq. I showed you the Nasdaq was in a death cross. The Russell 2000. The Russell 2000 is in a death cross, right? Rejection, failed, bounce. We got that double bottom. It is holding the 20-day moving average. Russell 2000 can have a mind of its own. You can see it cross way before the Nasdaq, but the S&P 500 is still above. Mainly the S&P 500 is still above because it does have some more conservative sectors like real estate and utilities, where technology is more growth, biotechs, technology-based type of stuff. So this can kind of have a mind of its own, and it is definitely a lot more volatile. This was a nasty, nasty downtrend right here. So you want to be cautious. I like to trade the Nasdaq. That's just me. But as far as the best thing to, in my opinion, to look at the overall health of the market, I think the S&P 500 is the most diversified. Okay, well, let's look at some market breadth. Let's look at the S&P 500 breadth right now. See if we are, you know, still in corrective territory. So 48% of the stocks in the S&P 500 are still above their 200-day moving average, but, you know, that means that 52%, a majority, are still below, right? A majority of S&P 500 stocks are still below the 200-day moving average. That's not really a healthy market, right? If we get a rally coming out of this, I really want to see that broad participation coming out. But as you can see, the 20-day moving average, this is kind of rally mode right here. In the S&P 500, you have 73% of stocks above their 20-day moving average. So you are getting some stocks that are trending higher, and this is the 50-day moving average, but a majority of stocks are in a long-term downtrend, short-term, but they are in a short-term uptrend. So you want to play the rallies, but you want to, again, have an exit strategy for if and when it rolls back over by selling half in a strength, letting a little bit run, and making sure that you don't roll over if it starts to chop around and become difficult again. Okay, it's very, very important. So if we look at the high-low breadth, another S&P 500 breadth indicator, so you have the sell-off right here. This is a chart of the SPX up here, and then look at all the distribution on the waterfall, right? This started right up here. Tons of distribution. On this bounce, not a lot of accumulation, and so far just not a lot of accumulation to match this kind of distribution. So I mean, these are the net highs minus the net lows, and then you get this indicator. But again, you want to be cautious because you look for a breath thrust out of this, right? Just where you're just getting tons of breath, tons of participation. So far, we haven't had that in the S&P 500. Mid caps, definitely not. You could say it looks similar, but worse. Small caps looks worse than all of them. And then I'm kind of looking back up here. So the Nasdaq, this little bitty high-low looks a little better than all of them. But again, lots more distribution. So just keep in mind, or lots more of net lows, percent lows. So this is just another breadth indicator. But again, we're trying to look at the overall market objectively. Okay, we're trying to look at it objectively. So just keep in mind, everything, you trade off price and volume, but you have these secondary indicators like the breadth, sector rotation is a secondary indicator. You want to have them in the back of your mind, right? You want to look under the hood. Right now, breadth is still weak in the big picture, but in the short term, it is getting a little stronger because if we look at individual sectors, right, 73% of the S&P 500 stocks are above the 20-day EMA. And this is the 20-day EMA breadth indicator for all of the sectors. Technology, 77%. Financials, 81%. So financials is a little bit stronger. Consumer discretionary, 73%. Industrial, 78%. Healthcare, 85%. Healthcare is the strongest so far. Consumer staples, 68%. It's okay for that one to be weak because that's more defensive type names. Energy is by far the weakest, just getting slaughtered, taken out to the woodshed. No love for energy right now. Not even in short-term bounce or rally mode. Materials are 62%, also weaker than the others. And then utilities are also strong, matching with healthcare. So utilities are still strong. It's a very defensive play. So just kind of keep that in the back of your mind that there are a lot of institutions, smart money, whatever you want to call it, they're still hanging on their utilities, expecting more volatility. So let's look at a chart of the long-term TNX. Where is that? Right there. So I want to look at yields because obviously they have been, top of mind. This is a yield chart. A 10-year Treasury yield chart going back to 1974. I love looking at long-term charts because it can really paint a very long-term picture, just because history has a way of repeating. But, with yields, it's just very interesting how you really have Treasury yields that, topped in 81 or late 81. So you have Treasury yields that tops in 81 and yields have been in a bear market. That means that bond prices have been in a bull market for 30 years, 81 to 2011, which I want to say it started to change. That's one hell of a secular bull market in bond prices, one heck of a secular bear market in yields. But now the tide is turning, and I think you have it breaking out of this long term, this head and shoulders. I would say this is a 8-year head and shoulder pattern. You had a straight off the bottom, bull flag, breakout, pause, breakout of this long term downtrend. So I would say that as far as Treasury yields, and I know this is no surprise, but I think the tide is turning the other way. So I'm showing you that just to tell you, we talk about diversified portfolios, and I'm not telling you not to be diversified in bonds. All I'm saying is, based on this 30-year chart, you could have, you never know, you could have, a 5, 10, 20, or 30-year secular bear market in bond prices, which this is showing. Doesn't mean it's going to be, just straight down. As you can see, there's a lot of chop, and this is a weekly chart, but this is a very, very long-term chart, a 45-year chart, so just keep that in mind. Doesn't mean it's going to happen, but I'm just saying, sometimes what we think, bonds have done so good over the last, 40 years. 35 years, it can go the other way. So what you think is conservative, because that's all you know, bond prices typically hold up, it could not be that way for the next 5, 10, 30 years. So yields historically, even though right now they're negatively correlated, but I think it's safe to say yields are historically correlated with financials. So long term, you know, your banks, your insurance companies, right? When high interest rate environments, they typically do better because the spreads they can make on loans are better, and are negatively correlated with utilities. And I know utilities are strong in the short term, but again, keep in mind, this is very, very long term, big picture stuff we're talking about here. So historically, I'd say the line is negatively correlated with yields. So when yields go up, you know, it's negatively correlated with utilities, and when yields go down, it's positively, you know, they're going to go, excuse me, they're still going to be inverse. So long term, I think if you have a 20-year time horizon and you're a buy and holder guy, financials probably wouldn't be a bad thing to look at. This is going to be kind of a longer webinar because I just haven't done this in a couple weeks. Let's look at, I want to look at the CRB. Where? I think the CRB2. I think that's the one. Okay. So typically commodities and the dollar have an inverse relationship, as we know. So when the dollar goes up, commodities go down. You can see they cross, and the dollar is the purple. The price action is the CRB, the commodity index. So I'm not a fan of buying and holding in commodities. I know Jim Rogers thinks differently because he created a commodities index, but here's why. Commodities can be out of favors for years and years and years. I'd rather just have my money in something stronger. And this is just one of those simple things where you can just do a golden cross, death cross. You know, the death cross happened, the 10-week moved under the 40-week, you're out, and you'd have avoided all this crap. Right, you get back in right here, a lot of whipsaw lately. So maybe this is one big bottoming pattern. All I can tell you is you're now in a death cross, and it is undercutting lows right here. And a lot of it has to do with oil, but it also has to do with a strong dollar. We'll look at this chart of the dollar. So commodities, in my opinion, there's just so much negativity. You don't know what's going to happen. Oil is looking incredibly weak, even though it is down 35% from the high. We're going to look at a chart that shows that it has the potential to go much lower. But commodities are negative. Let's look at the inverse of commodities. Let's look at the dollar. Just a simple chart of the USD, the weekly. You can see an inverse head and shoulder, breakout, shakeout, bullish cup with handle. You know, the dollar is in an uptrend. Like, it's just clear as day. If I were to draw a downtrend line right here, I broke out of that. I broke out of the neckline of the head and shoulders. Broke out of this cup with handle. Doesn't mean it's just going to shoot straight up to the moon, right? But it's in an uptrend, right? And that has a negative impact on emerging markets and on international stocks. This is the relative chart of emerging markets versus the S&P 500, and a relative chart of the S&P 500 versus international stocks. And you can see that, you know, really this has been in decline. Same thing with small caps. Small caps typically do better relative to the S&P 500 when the dollar is weaker. Excuse me, when the dollar is stronger. So let's look at this. And this small cap isn't always holds true, because small caps also can come under pressure if the market comes under pressure. But if you look, small caps underperformed the S&P 500 when the dollar was down, and then when the dollar bottomed, it started to outperform, right? So it's not a perfect relationship, but typically small caps do outperform large caps when the dollar is strong, except for as of lately because we've been in a sell-off. But you know, when you have a stronger dollar, typically U.S. stocks do outperform international stocks. As you can see right here, it's been really going sideways, and as of lately, but still typically you can see right here, you have the strong dollar move right here, and the S&P 500 is outperforming emerging markets, is outperforming international markets as well. So, but as of lately, you can see that really, for the most part, the international stocks and emerging markets have been trading in line with the S&P 500. Maybe even emerging markets have slightly outperformed, because when this goes down, that means the relationship's inverse. I wouldn't say this is a definitive break the other way yet. We'll just really have to wait and see. But eventually, new leadership will emerge, and international stocks will kind of take that momentum-based leadership over the S&P 500. So I do just want to look at the VIX real quick. I don't make trading decisions off the volatility index at all. But again, it's just one of those. But again, excuse me, I keep having to pause, been under the weather. But again, it is one of those just secondary indicators I do like to watch a little bit. You know, and a lot of times, you know, when I have this purple line right at the 20, when the VIX is hovering around the 20, it does mean you are in a more difficult environment. You know, when the VIX surges above the 20, you really need to be cautious. A lot of people, you know, see that as a selling exhaustion. You know, just looking back the VIX over the last 10 years, what I have found is that first initial surge above 20 in the VIX typically is not your buying opportunity. Typically, that's the first crack in the dam, and then the VIX will go down. And it'll go down, it'll come down, and then it'll take that second leg down again. So you just need to be cautious. But, you know, the VIX is still around 19, which is high. You definitely want it below 16 to kind of be in a more favorable environment, but we can't always have what we want. But it's just something to be cautious. You know, typically, you know, one could also have a rule if the VIX is above 20, you know, you're in a lot more tougher environment, so it might be safe to limit your trading. Let's look at oil, and then we're going to look at some individual sectors and industry ETFs. So, you know, people are asking about oil, so I just do want to address this with a simple chart. You never know how deep the sell-off is going to go, you know, but here's the thing that's interesting. You know, back when oil was 107, this is West Texas, a weekly chart. Back when oil was 107, you had that death cross. Again, you have the death cross right here. You can get out cheap. And then it just absolutely got slaughtered, right? Down 60% before it even attempted to bounce. That was a failed bounce, right? Then you had another stab and then break through. You kind of see, kind of looks like the market sometimes, right? You get that double bottom and then boom, get a little rally and then it rolls back over. So, it just went 60%. And what was interesting is during this 60% decline, I can't find anything where it was back-to-back up weeks, like very small bounces, and then you had 3 weeks up for an attempted rally, failed, and then you have your reversal, and then you have a better rally, but again, that rally eventually failed, so you just really want to be cautious, especially after sell-offs like this. Typically, the bounces aren't V-shaped. You can get a bounce, you can get a rally. Typically, that's all it is, and it does need time to digest these moves. So far, this whole move, we haven't had a single up week. The oil is down 35% from its high, from 76.90 all the way down to $50, where it currently resides, with a 35% decline. Not a single up bar. So if you get, if you're looking for an entry in oil, if you are, but I hope this just kind of shows you how deep it can go. But if you're looking for an entry in oil, you know, for me, I'd be looking for some kind of reversal and above average volume. And then I would correspond that with oil stocks as well, XLE, XES, ETFs, to make sure that those are reversing as well, you know, to kind of confirm what I'm seeing on the actual price of the crude. But this is nasty. I mean, it's just... It is. And oil stocks, what's interesting is, let me go over to XES for a second. I'll have to... Let me get through this. I think this is a chart I want to find. Okay, so West Texas is in this window. Then you have XES, oil and gas equipment ETF. So what's interesting to me is you have a 158% move from the bottom in 2016 of West Texas, approximately, to the top where I was at 75. Now from the top, you have approximately 32% climb, 33. I know on the other chart I had 35, but it was more of a, it's not exact. I'm just kind of dragging here. But West Texas definitely broke this trend line right here. Really, as these were starting to just really roll over, and then they all bounced with oil, but it just, sometimes you can look at oil stocks for a signal, because you can see West Texas came back and slightly beat this all-time high. Oil stocks were nowhere near it. They didn't come anywhere close on that bounce and just got slaughtered. And what's really interesting to me is, oil was down, I know, at around 26 at this low, and is still up, $50, almost double. If you look at this ETF, it is lower than when oil was at 26. So you have oil that is still almost up approximately 100%, call it 95%, from its 2016 low. Up almost 95%, and then you have the actual oil stocks that are even lower. So that to me is just throwing so much negative signals, and I'm like, I don't know what's going on. This is a really ugly chart. I'm getting really ugly signals from the actual stocks. I don't want to trade it. So let's go to the member dashboard. The Nasdaq, again, come on. Actually, I want to go back here. Let's kind of pull up the Nasdaq. So again, this is really what you want to see after kind of a couple of days of an attempted rally, right? You are well off the lows of the midday, right? You start okay, start sell off, and then come back. Even if it's a down day, to me, if this closes anywhere near here, I would say that's bullish. Now, it could roll over by the end of the day. I don't know. But, everything is close to the high of the day. If we go look at the market summary, this is what I do every day. Just what's the strongest, what's the weakest. We're looking at the sectors, right? All 10 sectors. Actually, there might even be 11 now because it added real estate and it added this communications. So 11 sectors. So today, energy is the strongest, technology is the weakest. Technology, financial, discretionary are the weakest. That's really not what you want to see, but I'm not too worried because the Nasdaq's only down, 1/10%. So this ETF, which is probably market cap weighted. But actually, let's go over here to look at the sector summary, because that's really what I want to dive deep into. Let's look at this week, right? Let's look at 1 week. So 1 week, discretionary, healthcare, discretionary, technology. I mean, look at the scooter value. The scooter is the really the relative strength rating of this, and so you can see that the stronger stocks are leading this week. Utilities is towards the bottom. Materials, energy is towards the bottom. Even though energy is up today, it's still the weakest of the week. But if we go back 1 month, you're going to see a different story, right? Healthcare is still towards the top. I mean, that there should be so many kind of flashing lights when you see that. When you look at the 1 day, the 1 week, the 1 month, clearly, and then you look at the scooter value. I'm continuing to try to look at some of these healthcare stocks to see, because they are showing a lot of relative strength, a lot of resilience in this environment, and that's exactly what you want. So healthcare is looking good. Let's go over to just kind of look at some individual industry ETFs to continue to see what the strongest and what is the weakest. That's a chart of the Nasdaq. Let me kind of pull this up right here. So you have MLPs, energy, copper miners are up the most, but really what I want to do right here, so I want to rank this by relative strength. That shouldn't be like that. I want to rank this by relative strength rating. just look at some of the ETFs. If any ETF really held the 200-day moving average in this most recent sell-off, that's pretty bullish. Healthcare providers right here. These are 25 industry ETFs that I track. Healthcare providers, really, I mean, they are a ways above the 200-day moving average, 11%. And they're almost at an all-time high. Oh, you know, this is a honey hole you need to be fishing in. You can look at this industry ETF, or you can look at the individual stocks, break it down. Same thing with medical devices. Medical devices don't look as strong. They're not at a high. They still have 6% to go to hit this point. But now they're breaking through the 50-day moving average. You know, they found support. Again, you know, healthcare providers and medical devices, those are strong charts. Now, a lot of people say, hey, when you're in a correction, why don't you just invest in utilities? Here's how I feel about that. This is just my personal preference. If the market is so bad that I'm just trying to get a few yield points in utilities, I'd rather just be in cash, because utilities can go down. They can go down with the market. You know, sometimes they just hold tight with the market. They're not always even going to go up, but I mean, why risk it? You know, if the market is getting slaughtered and utilities are holding up, unless utilities are just going on a massive rally, like I'm just going to stay out of it. It's just not for me. Jets, global. Let's look at the weekly chart here. So this ETF is interesting, and I like it because it's a good case study for a lot of reasons, right? You have a lot of consolidations, a lot of breakouts that failed. Yeah, this breakout didn't go very far, failed, fell into another cup with handle, failed, rolled back over. You got another cup with handle, failed. Now you're in your fourth. Your previous 3 consolidation breakouts have failed. Now you're in your fourth one. So, you know, the way I look at it is the more, just like anything, you know, whether you're flipping a coin, you know, betting black or red, just like anything, the more failures you have, the likelihood that it just wore everybody out. No one wants anything to do with it, right? They're tired of it. They're going to take it off their screen. They're ignore it. And then boom, there's your big run. There's your big winner right there. So we've had 4 failures, and now we're, 3 failures, and now we have another setup. With oil being weak, you know, this is probably something to consider. And if we want to break that down even further, what are some of the, let's just look at a couple airline stocks. Let's look at the strongest ones. This one is definitely. So I got the top relative strength ones right here. Mesa. Nope, that's not what I want to look at. Spirit. Look at Spirit. Spirit Airlines. This thing is chugging up 20% this week. Just moving along, coming out of just a deep consolidation. Not even back to the December high, not even close. So you might want to wait for a pullback closer to the 10-week moving average. But this is a very strong stock. Look at all this accumulation. And that's just what you want to see. You want to see accumulation on the upside, distribution on the pullback, and then boom. I don't know, this doesn't look like an earnings week, but it's still up a lot. Let's go to the next one on the list. Look at all this again. You know, you have this kind of ugly double bottom, no real consolidation in sight, but look at 5 straight weeks of huge above average volume accumulation. That is not you or me. That is someone big stepping in, buying shares, good relative strength line, rising, outperforming the market. Now it's looking like it's ready for a pause. So when it's looking for a pause, you're looking for an entry, a pullback to the 50-day. This seems extended to me, but if the pause goes longer sideways, then I would more likely consider a horizontal breakout to the upside. So again, another strong airline. We always want to focus on the strongest. United Continental, not as much accumulation as the other 2. So again, price action is at an all-time high, but there's not as much accumulation as there was on Spirit Airlines and on the other one we just looked at. But again, this relative strength line sure does look good. So we'll continue to, that's the one we just looked at. Moving down. Azul. This is I believe this is a Brazilian airline. I love to see the year-over-year earnings acceleration. Love to look at return on equity. High, everything looks good. Major accumulation on this leg. Now we need to wait for a pullback, a consolidation, a pause, and see if it can continue its advance. This looks right. It looks right along with the other airline stocks. Let's just look at the last one, Alaska Air. Not as much accumulation as the others. So as far as accumulation goes, SAVE, GOL, and AZUL would be my top three, even though this is looking good. It's breaking out on above average volume this week, but not as much accumulation in the previous couple months. I want to ride the coattails of some strong institutions. So these are really the strongest. Let's look at some of the weakest, right? XES, we already looked at that, looking pretty weak. If you want to play a weekly reversal on this one, so be it. Put your stop, you got your game plan in, but I just don't know if this is for me. Copper miners, also just in the death cross and a downtrend. Nothing there to see. Home construction, it's death cross happened a long time ago. So, again, you think of, you only have so much capital. Why not invest in some strong momentum, things that are moving up instead of trying to pick a bottom always? Now, this is one that is looking interesting, I'm going to say. Why am I going to say this? Because you got a weekly reversal pattern on the XME. You got a weekly reversal right here in the works. Now, this has to close positive. You got a weekly reversal pattern and above average volume. You haven't had was this a weekly reversal pattern? This is the first weekly reversal pattern you have had in this whole downtrend. This is the first one. So again, a weekly reversal has to undercut the previous week, close above the previous week, and above average volume. So there you have it. I took a lot longer. I mean, I still have more charts, but I took a lot longer just because we haven't done this in a couple weeks. So I hope everyone had a happy Thanksgiving. I hope you have a happy Merry Christmas, holidays, and let me know if you have any questions.